Silver did not simply fall on Friday. It was slammed, forced lower, and torn apart in a matter of hours. The paper price collapsed, traders were wiped out, and everyone was told the same story. The rally was over. But that story falls apart the second you look at one chart nobody wants to show you. The miners did not collapse with the metal, and that changes everything. A normal sell-off does not look like this. A real breakdown does not behave like this. If silver truly imploded on fundamentals, the companies that live and die by silver prices should have been annihilated. They were not. They fell, yes, but nowhere close to what history says they should have. That is the first crack in the official narrative, and once you see that crack, the whole structure starts to break. I kept coming back to the same question. If silver really suffered one of the ugliest single-session breakdowns in modern history, why did the miners hold together so much better than expected? These are not side businesses. These are real operators with mines, labor costs, equipment, fuel bills, and exposure to silver prices every single day. In a genuine collapse, they usually exaggerate the move. They do not cushion it. That relationship has been one of the cleanest patterns in commodities for years. Silver rises, miners usually rise more. Silver falls, miners usually fall harder. Leverage works in both directions. So when silver got crushed and the miners only dropped a fraction of what they should have, that was not some random market quirk. That was a message. And the message was simple. The people with the deepest pockets did not believe the crash. Think about what that means. While retail traders were getting margin calls, while headlines screamed panic, while charts were flashing red and people were dumping positions in fear, large money did not behave like this was the end. The institutions that own mining shares did not react as if the silver story had broken. They reacted like they were watching a temporary event, not a permanent repricing. That should make you uncomfortable. Because when price action, miner behavior, and institutional positioning stop matching the public narrative, one of two things is true. Either the market is missing something huge, or somebody engineered the move, and the biggest players already knew what it was. So I started pulling on the thread. The deeper I went, the worse it got. Not because the evidence was hidden. The disturbing part is that most of it is public. It is sitting there in exchange data, enforcement records, penalties, and trading reports. The pieces are available. Most people just never put them together because they are too busy reacting to the price candle in front of them. Here is what matters. Friday's collapse did not happen in a vacuum. It came after a perfect emotional setup. Bullish messaging pulled money into the trade. Optimism exploded. Silver ran hard. Targets got more extreme by the hour. Then the tone flipped. The macro signal reversed, and a one-way trade turned into a trap. The same market that invited buyers in suddenly became a liquidation machine. That alone would be violent enough. But the timing was too clean, too efficient, too damaging to the exact same group every time. And that brings us to the mechanism almost nobody explains properly. Spoofing. Spoofing is not some abstract technical term. It is one of the clearest forms of market manipulation you can imagine. A trader floods the book with large fake orders to create the illusion of heavy supply or heavy demand. Other participants react to the fake pressure. Price moves. Then the manipulator pulls the orders before execution and profits from the move they helped create. It is deception with a trading screen attached to it. And this is not a theory about precious metals. The biggest banks on earth were caught doing it. Over the last 2 decades, multiple major financial institutions were punished for manipulating gold and silver markets. Not rumor, not internet speculation, not people are saying. Regulators documented it, courts handled it, traders were convicted, some went to prison, massive fines were issued. The record exists, and it is ugly. One bank paid a penalty so large it became the headline example of how deep the rot had gone. Others were hit as well. Different names, same game. Precious metals desks, fake orders, deceptive conduct, years of abuse. And what was the real lesson the market learned from all of that? Not that the system was cleaned up. The real lesson is that the practice was profitable enough to continue for years before anyone forced it into the light. That is the part people do not want to say out loud. If manipulation generated huge gains for a decade, and the punishment later amounted to a business expense, why would anyone assume the behavior vanished forever? Why would anyone believe the incentives suddenly became moral? These desks do not run on shame. They run on profit. Now hold that thought and look at the trading behavior around the crash. On the day silver was smashed, several of the same institutions with long documented histories in precious metals manipulation were seen closing positions into the collapse. Not near the top, not randomly in the middle, near the low, near the zone of maximum panic, maximum damage, maximum forced selling. Right when weak hands were being cleaned out, the smart players were stepping away with gains. That timing matters. In any violent sell-off, the difference between being early and being precise is enormous. Exiting close to the very bottom of a historic wipeout is not a trivial detail. It means either unbelievable luck or unbelievable awareness. And when the same cluster of names keeps appearing around these moments, coincidence starts to sound ridiculous. This is where the miner chart suddenly makes sense. The mining stocks were not calm because nothing happened. They were calm because the people who understand these games best did not treat the move as authentic price discovery. They treated it like a paper event, a burst of pressure, a forced unwind, a hit job on leverage. Something painful, yes, but not something that changed the real underlying silver story. That is why the divergence matters so much. The metal was punished in the futures arena, but the equities linked to long-term production did not fully confirm the message. In markets, that kind of non-confirmation can be louder than the headline itself. Then came the exchange response, and that is where the smell of panic got stronger. After the damage was already done, margin requirements were raised, then raised again. Then more pressure was scheduled immediately after. This is presented as prudence, risk control, stability, protection. But look carefully at the sequence. The violent liquidation happens first. Then the rules tighten harder. Then the survivors are squeezed again. That is not how a system behaves when it is calmly reducing excess before chaos. That is how a system behaves when chaos has already exposed a hidden weakness, and now somebody somewhere needs immediate protection. Because what do margin hikes actually do in practice? They force traders to post more cash or reduce positions. If participants cannot meet the new requirements, they are sold out. It does not matter what they believe about the asset. It does not matter if they wanted to hold. The position gets cut. That means higher margin in the middle of disorder is not neutral. It mechanically creates more selling pressure. So ask the obvious question. If the goal was to cool speculation responsibly, why not move earlier when the market was overheating? Why wait until after the destruction? Why hit again when confidence was already shattered? Why make it even harder for anyone to absorb the shock? Because this was never just about calming volatility. It looked like emergency containment. An emergency containment usually means one thing. A large player was in danger. Somewhere in the chain, someone appears to have been too exposed, too leveraged, too vulnerable to a continued rise in silver. And when that risk reached a point that threatened the plumbing of the system, everything became acceptable. Narrative reversal, liquidation cascade, margin pressure, psychological warfare. Small participants pay the price. The system buys time. If that sounds dramatic, go back and study history. The playbook is not new. When silver has surged too far, too fast, and too publicly, rule changes and margin pressure have shown up before. Different decade, same rhythm. A major rally captures public attention. Retail participation expands. Excitement builds. Then, at the moment of greatest vulnerability, trading conditions change, leverage is attacked, and price is broken. It happened in an earlier generation, when a huge silver run ended in a brutal collapse after exchange action rewrote the playing field. It happened again decades later, when repeated margin hikes turned a spectacular rally into a historic breakdown. And now here we are again, staring at another violent reset that followed the same emotional arc and the same institutional reflex. Once as a surprise, twice as a pattern, 3 times as a system. That is why the free market explanation feels so weak. Real markets can be emotional. Real markets can overshoot. Real markets can crash. But when the same asset keeps meeting the same type of intervention at the same phase of the cycle, skepticism stops being paranoia. It becomes basic pattern recognition. And if you still think the paper price told the whole truth on Friday, then explain the physical market. Because the physical market did not behave like silver was cheap and abundant. It behaved like supply was strained and confidence in quoted price was breaking down. Premiums stayed elevated. Inventory tightened. Dealers did not act like they were drowning in metal. They acted like real silver was harder to secure than the screen price suggested. That disconnect matters more than most people realize. A futures price can be hit with leverage, size, speed, and positioning. Physical supply cannot be invented by keystroke. You cannot print coins. You cannot spoof bars into a vault. If the paper market says one thing, while the real-world product commands much more, and availability worsens, the tension between those two realities becomes the real story. And then came the weekend signal that pushed this from suspicious to alarming. A major private mint suspended silver sales because it could not source enough metal. Read that again carefully. Not because demand vanished, not because nobody wanted to buy, because metal could not be secured. In the middle of a so-called price crash, a large seller of physical silver was effectively saying the underlying product was not easy to obtain. That should stop you cold. If silver were honestly available at the crushed paper price, the logical response would be to buy every ounce possible and resell into demand. That is what a functioning market does, but a shutdown tells a different story. It suggests the quoted price on the screen and the actual condition of physical supply are no longer aligned in any healthy way. This is how fractures begin. First, the paper market takes price lower. Then the physical market refuses to fully cooperate. Premiums rise, product disappears, delays increase, confidence weakens, and suddenly what looked like a clean chart move starts to resemble stress inside the system itself. That is why I do not think Friday changed the silver fundamentals at all. Industrial demand did not vanish in one morning. Solar did not stop needing silver. Electronics did not stop needing silver. Grid infrastructure did not stop needing silver. The modern economy did not wake up and decide silver had become optional. None of the real-world consumption drivers were destroyed by a violent futures flush. What changed was ownership. Metal and exposure were ripped away from weak hands and transferred toward stronger ones. That is what these events do best. They terrify leveraged participants. They create forced selling. They produce emotional capitulation. And they allow disciplined or informed money to take the other side while the public is in shock. That is also why I expect the rebound, when it fully comes, to catch a lot of people flat-footed. Because the same machinery that can create a vertical drop can also drive a vicious recovery. Once the shorts have covered enough, once the forced selling is exhausted, once the remaining participants are too scared to re-enter, the market becomes thin and unstable in the opposite direction. Add physical tightness to that, and the snapback can be brutal. And there is another layer here that should worry everyone. The aggressive margin response suggests hidden stress may still be unfolding. Exchanges do not move like that without reason. Systems do not tighten that fast unless somebody behind the curtain has become a problem. Maybe it is a position. Maybe it is collateral. Maybe it is a chain reaction nobody wants discussed in public. But something about this move looked defensive, not confident. That is why this matters beyond silver. Sometimes the first sign of a wider financial break is not a giant headline. It is pressure showing up in odd corners first. A sudden dislocation here. Emergency rule changes there. A supply shortage that should not exist. A pattern that feels too coordinated to dismiss. Stress rarely introduces itself politely. It leaks. One more thing. People keep asking why this matters if they do not trade futures. It matters because paper price still sets the emotional tone for the entire market. It influences headlines, sentiment, portfolio decisions, minor valuations, and public perception. So when that price is distorted, even temporarily, it ripples outward and changes real behavior. People sell real assets because of fake pressure. They abandon long-term positions because of short-term manipulation. That is the damage. Not just the candle, but the psychological shock attached to it. And that is exactly why these operations are so effective. They do not need to convince everyone forever. They only need to create enough fear, fast enough, to force bad decisions in the moment. Once that happens, the transfer is complete. The weak hand exits. The stronger hand absorbs. The screen resets. The story gets rewritten. And the public is told it was just the market being the market. So where does that leave us now? It leaves us staring at a market where convicted manipulators have historical precedent, suspiciously precise timing, public records tied to the crash window, miners refusing to fully validate the sell-off, physical supply refusing to confirm the paper price, and exchange actions that look more like triage than routine oversight. That is not normal. That is not clean. That is not the behavior of a transparent, healthy, honestly functioning market. It looks like a crime scene with a ticker symbol attached to it. And the most important part is this. The people who held their nerve through the crash may have been telling you the truth long before the commentators did. The miners did not scream collapse. The physical market did not scream abundance. The exchange did not act relaxed. Everything around the event pointed to stress, intervention, and forced movement, rather than natural discovery. So now the real question is not whether Friday was painful. Of course it was. The real question is whether you still believe the pain proved the underlying silver case was broken. Because I do not. I think the crash exposed the system more than it exposed silver. I think it revealed who gets protected and who gets sacrificed. I think it showed how quickly the rules can tighten when the wrong people start making the right trade. And I think a lot of investors are going to look back on this event and realize the biggest mistake was treating a paper ambush like a fundamental verdict. Watch the miners, watch physical premiums, watch delivery stress, watch inventory, watch the places where reality cannot be manufactured with a sell order and a headline. That is where the truth starts to leak out. And now I want to hear from you. After everything you have seen, do you still trust this market to price silver honestly? Do you think this was a real collapse or a paper operation designed to flush out weak hands? Put it in the comments. And if this opened your eyes, subscribe now and stay close. Because when the next crack appears, when the next signal hits before the crowd understands it, you do not want to be the last person in the room pretending this system is clean. They want fear. They want confusion. They want you to see a red candle and forget everything else. Do not make it that easy for them. The evidence is already on the table. The pattern is already there. The names are already in the record. The market told you one story on Friday. The miners, the physical supply, and the exchange response told you another. Only one of them can be true. Now watch what happens next.